Hi, this is Eva, and this time I want to explain about a big common question mark which is in people's mind, specifically investors. Do you own a second house, or are you thinking to purchase an investment property? Are you worried about capital gain tax? Have you heard about the tax? So today I want to talk to you about a couple of expressions which you may hear from your accountant or in the media, but may not make sense or may not lead you how to calculate your capital gain tax, or doesn't result that if you know how to calculate how much you're going to get taxed. First expression or first item you need to know in order to know what is your capital gain tax is the proceeds of the disposition. What does it mean? It means how much money you get after you sell your house, how much remains for you. Second expression is the adjusted cost base, which you may hear it as the ACB, which means how much did you pay to buy this house, how much, including all extra costs. For example, land transfer tax or any other cost while you were purchasing this house. So that's called ACB. The other one is number 3, outlays and expenses incurred to sell the property, such as commissions, broker fee, finder fees, transfer fee, tax, marketing fees. There are lots of fees when you sell the house. So how to calculate it? In Canada, in Ontario, in fact, any property which is not your residence property is called investment property unless you are residing in it. So if you have a second house, it's gonna attract capital gain. Now let's understand how does it work, because it seems very frustrating when you don't know the calculation methods, but when you understand it is a little bit better. Any amount, any margin you have after all these expressions, if you deduct all your expenses from what you purchased, or let's say you have $20,000, $30,000 pure margin, pure profit from your second house, the house which is not your residence house. If it's a residence house, there is no capital gain tax, because if you want to buy another house, again, you have to purchase at a higher amount, so there is no benefit. It's just the place of where you reside, where you live, so it's not for business. But if it's a second one, then it attracts capital gain. How is it calculated? Let's say, for example, you have gained $30,000 as a margin, as a pure benefit, after deducting all those expenses. You bought the property $500,000, you sold it at $600,000. When you deduct all the expenses, then the pure amount is $30,000. Sometimes even all those repairing, maintenance, everything is being deducted, even property tax. This $30,000 in Ontario government, according to CRA, they take off 50% of that. Means $15,000 is going to be added to your income bracket tax. So do we know how much you're going to get taxed? No, we can't understand, because it's based on person to person. If your bracket tax is, if you're making $100,000, then your income that year is going to be $115,000. So you're going to get taxed based on $115,000. If someone is $40,000, then it's going to be $55,000. So they're going to get taxed based on $55,000. Someone with no income at that year probably is not going to attract that much capital gain tax. So in fact, we can't calculate the exact amount for everybody, but that is a calculation method to understand how you attract capital gain tax. So in fact, it depends on the time you sell, it depends on your income and all other circumstances at that time, but now you know the calculation. Please do not hesitate to contact us if you have any questions. We would be happy to assist.